If you just take a quick glance at the headlines right now, you would probably think that everything in our economy is going fantastic. You hear about corporate profits hitting numbers we have never seen before, and you watch the stock market climbing higher and higher, breaking records left and right. It feels like a party that never ends. But I am here to tell you that if you stop looking at the shiny surface and actually grab a shovel to dig a little deeper, the picture changes completely. You start to see that the foundation isn't as solid as they want you to believe. In fact, there are serious cracks starting to spread underneath everything. The reality is that when people say the stock market is booming, they aren't telling you the whole truth. It turns out that the entire market isn't actually doing well. What we are witnessing is a situation where just a tiny handful of massive companies are doing all the heavy lifting, essentially carrying the entire rest of the stock market on their backs. While those giants are partying, the average American people are slowly finding themselves in a tougher financial spot. You are likely seeing it in your own life. The average American is getting poorer because the price of everything you need to survive keeps climbing due to inflation, while at the same time, the job market is getting shakier and going down, partly because artificial intelligence is starting to displace workers. You really need to sit up and pay attention to this specific dynamic because history has a habit of repeating itself. The history books show us that whenever the stock market is being propped up by just a few giant pillars rather than a broad base, it becomes incredibly fragile. In that kind of environment, even a tiny crack in one of those giants can spiral out of control and turn into a massive problem for everyone. That is exactly why I want to walk you through what is actually happening beneath the hood of this economy. My goal is to show you how to not only build a wall of protection around your money, but also how to spot the investment opportunities that most other people are completely missing because they are too distracted by the headlines. So please stay with me as we break this down. The news stations keep shouting about how corporations are raking in record profits, and they use that to explain why the stock market keeps hitting new all-time highs. But what they are ignoring is a massive separation, a divergence, happening right in front of our eyes. You have a very small, select group of companies that are dragging the market upward, while the vast majority of the stock market is actually slowing down and struggling. Let's get specific so you know exactly who I am talking about. We are talking about 7 specific stocks that people are calling the Magnificent Seven. This list includes Meta, Alphabet, Amazon, Apple, Microsoft, Nvidia, and Tesla. When you look at the third quarter of 2025, these 7 companies saw their earnings grow by an incredible 14.9%. That is a huge number. But you have to compare that to the rest of the market to understand the danger. If you look at the other 493 companies that make up the S&P 500, which is supposed to represent the 500 largest and most important companies in the stock market, their growth was only around 6.7% in terms of profits during that same time. Why should you care about the difference between 14.9% and 6.7%? You care because if you look back over the last 10 years, the average growth rate for a quarter is usually around 9.2%. This tells us a very clear story. Those 7 giant companies are growing way faster than what is normal, while the other 493 companies are actually growing significantly slower than the historical average. The engine of the economy isn't firing on all cylinders. It's running on just a few supercharged ones while the rest are sputtering. But the growth rate isn't even the scariest part. The real reason this is so critical is not just that some companies are faster than others. That is always going to happen in a free market. The problem is the sheer size of these winners. These certain companies have grown so large that they now make up a dangerously huge percentage of the entire S&P 500 index. Just these 7 companies, all by themselves, account for roughly 33%, that S 1/3, of the entire value of the S&P 514. Think about that. You have an index of 500 companies, but just 7 of them dictate 1/3 of the value. This is where the situation gets risky. Because they hold so much weight, if just one of those 7 companies has a bad quarter or starts to stumble, it is not just a problem for that company or the people who work there. Because they are so heavy relative to the rest. Now, usually, when you are in a bubble, there is a mechanism to pop it. But right now, we are seeing a situation where we are actually starting to inflate this bubble even more rather than letting the air out of it. Here is how that works. Normally, when the Federal Reserve raises interest rates, that is the pin that pops the bubble. The logic is simple. When you raise interest rates, it becomes expensive to borrow money. When debt is expensive, investors have to be careful. They can't just throw money at crazy ideas. They have to be cautious about where they put their cash. High interest rates force you to be less speculative. But look at what is happening right now. The Federal Reserve Bank is not raising interest rates. They are doing the opposite. They are cutting interest rates. When rates get cheaper, it costs less to borrow money. When money is cheap, I can afford to take big risks. I can make more speculative investments. I can throw money at high-growth, risky tiers of the market. So, generally speaking, Lower interest rates do not pop bubbles. They act like a pump that inflates them further. And it is not just the interest rates. On top of that, the Federal Reserve Bank is also ending a program called quantitative tightening. They officially ended this on December 1st. In plain terms, ending quantitative tightening means the Federal Reserve is going back to making money loose. They are working to encourage banks to lend more money and encouraging regular people to borrow more money. They are doing this to continue fueling the markets and to keep this entire financial system moving forward. What this ultimately means for you as an investor is that those 7 companies, the Magnificent Seven, have no choice but to keep growing like crazy. The investors who are buying stocks right now are paying what we call a premium. This means they are paying very high prices or high multiples to own a piece of these companies. The only reason investors are willing to pay these expensive prices is that they truly believe these 7 companies are essentially going to take over the world. They are betting that these companies will keep growing at lightning speeds forever. But here is the trap. If these companies miss that mark, even by a little bit, trouble starts. If artificial intelligence doesn't grow quite as fast as people expect, or if these companies don't make as much money as investors are dreaming of, that disappointment could trigger a massive sell-off. And remember what I said earlier. Because these companies make up 33% of the market, if that sell-off happens, it won't just hurt those specific stocks. It could bring the entire stock market crashing down. This is exactly where educated investors start to get concerned. Now, I am not telling you this to scare you away from investing. It is incredibly important for you to be an investor, but it is equally important that you know how to analyze what you are buying. You need to understand the mechanics. There's one more massive reason you need to pay attention to this bubble situation. When you go to invest your money in the stock market, you generally have 2 main options. Your first option is to invest in an individual company, like logging into your brokerage app and buying one single share of Apple. Your second option is to invest in a fund. A fund is basically a basket that holds lots of different stocks. One of the most popular baskets in the United States today is an S&P 500 fund. When you buy this, you're investing in the 500 largest companies in the stock market all at once. You might know these by their ticker symbols like SPY or VOO. And just as a disclaimer, I invest in these myself. These are just a few of the many ways to invest in the S&P 500, but here is why this matters right now. When you put your money into one of these funds, you think you are diversifying across 500 companies. But the reality is, the $100 you put into that fund is not spread out evenly. It doesn't give 20 cents to every company. Instead, your money is distributed based on the size of the companies, meaning more of your money goes into the big guys. And do you want to guess which companies get the biggest chunk of your cash? It is those same 7 companies we talked about earlier. The worry that many investors have is about what happens if we are all automatically buying these stocks at a value that is totally inflated. Let me give you a real number to make this stick. At the time I'm recording this, the average PE ratio, price to earnings ratio, for the S&P 500 is sitting around 29. What that means in plain English is that investors are currently willing to pay 29 times the annual earnings of a company just to buy a share of it. Let's break that down with a simple example. Imagine I started a small business, and in 1 year, I made $1,000 in pure profit. Now imagine I wanted to sell that company to you. If we use the current stock market valuation of 29, my company would be worth 29 times that $1,000 profit. That means you would have to pay me $29,000 to buy my business that only makes $1,000 a year. If you compare that to history, the average ratio is usually around 20 times earnings. So right now, stocks are trading for a very hefty premium. They are much more expensive than the average. Now, if you ask some investors why they think this is okay, they will tell you the market isn't overvalued. They will say this is just a normal part of the new cycle, and the reason they give is usually AI. Because artificial intelligence is changing our economy so rapidly, these optimists argue that you aren't really paying 29 times earnings for what is happening today. They say you are paying for the future growth we are going to see in 2026, 2027, and 2028. The theory is that AI is going to help the economy boom so hard that these companies will see massive explosions in profits and revenue because they can use this new technology to amplify everything they do. That is why investors are willing to pay such high, expensive multiples right now. They are assuming these companies are going to produce blockbuster results thanks to tech. But again, we have to be honest. That is a lot of hope and a lot of speculation. The deep concern is, what if it doesn't work out exactly the way these optimistic investors want? If we see results that are just good but not amazing, that could be viewed as bad news. That disappointment could bring one of these giant stocks down. And if one of those stocks goes down, yes, it hurts that company. But as we discussed, it drags down the value of the entire stock market. And the reason I keep hammering on this point is that you have to understand that human beings are emotional, and a lot of investors run on emotion. Let's say we see a pullback in the market. Nothing huge, just maybe a 10% drop. Normally, that is not a big deal. But today, we have more retail traders, regular everyday people, trading in the stock market than ever before in history. And to be blunt, the average retail trader often does not have the best psychological discipline. They don't know what to do when they see their account balance go down. They panic. Now, to be fair, a lot of the big institutional investors don't know what to do either. But the danger is that if the market starts to dip, it triggers worry. That initial dip can actually lead to the very thing people are terrified of, a market crash. It becomes a self-fulfilling prophecy. Markets start to go down. People scream, "Oh my God, the market is about to crash. I need to get my money out before it hits zero." And then, that act of pulling money out is exactly what causes the crash to happen. Specifically right now, people have shockingly high expectations. If those expectations start to cool down, if people start saying, "Hey, maybe AI isn't as powerful as we thought," or "Maybe this tech isn't as good as we hoped," or "Maybe these companies won't be as successful," investors will rush for the exit. That mass exit won't just hurt the tech companies, it will pull down the general market. And when people get scared and sell, it forces the market down even further. So, what does all of this mean for you personally? Does this mean you should hide your money under a mattress? Does it mean you need to wait to invest? Absolutely not. What it means is that you have to be aware. The reality of the game is that markets go up and markets go down. Just because we might be in a bubble right now doesn't mean there isn't money to be made. This is where having the right strategy becomes the most important thing in the world. The right strategy for you depends entirely on what your interests are and how much time you're willing to put in. You have to understand the different styles of investing so you can spot opportunities no matter what stage the market cycle is in. Let's look at option 1. If you are investing in passively invested funds, like the S&P 500 we talked about, that is great. But you need a strategy that ensures you win, whether the market is skyrocketing or plummeting. The strategy I like to teach, and again, I can't tell you what to do because I'm just a guy on the internet, and investing always carries risks where you can lose money, so do your own homework, is something I call ABB. ABB stands for Always Be Buying. Period 66. If you're going to be a passive investor in these big funds, you need to set up a system. Maybe it happens every week, every 2 weeks. The only time you should change the system is when the markets are crashing. But you don't stop. You do the opposite. You use the crash as an opportunity to potentially buy even more 70. When the market goes down, everything is on sale. You use that moment to buy more shares of the fund for the same amount of money. We know that over the long term, historically, markets go up. This analysis tells us to expect volatility. It doesn't mean the economy is going to break forever, and it doesn't mean the stock market won't exist in 20 years. It just means things are going to get bumpy. We have strong companies with big profits, but we also have investors speculating like crazy. When investors speculate, they get greedy. When they get greedy, they start betting with money they cannot afford to lose. So when the market turns and starts to drop, who is the first person to sell? It is the person who got too greedy. It is the person getting burned because they took too much risk. It is the people with too much debt who shouldn't have been gambling in the first place. When they pull out, the market drops, and that creates the opportunity for you. So, if you are passive, do not wait on the sidelines. Always be buying. If you do that long enough, the math proves you will win and build wealth. Now, let's talk about option number 2. I actually recommend that everybody does a little bit of this. You don't have to do it with all your money, but try being a partially active investor, even if it is just with 20% of your portfolio. Active investing isn't about day trading fast. It means investing in individual companies that you believe in. I won't lie to you. This takes more work. It takes more time, and it definitely carries more risk. But it also has much higher potential for upside. The reason I suggest doing a little bit of this is that if you really want to accelerate your wealth building, you need better returns on your money. And the basic law of finance is that you are not going to get higher returns unless you're willing to take on at least a little bit more risk. If you are willing to do your own research, actually studying investments and reading reports instead of just copying whatever is trending on Reddit or CNBC, you can find where the money is moving. That gives you a shot to beat the market. You are essentially studying the flow of money. If you can get just a slight edge on the market, the compound interest on that can grow your portfolio by thousands, tens of thousands, or even hundreds of thousands of dollars more over your lifetime, just because you squeezed out a slightly better return. So, to recap, active investing is picking individual companies. It is more work and risk, but more gain. Passive investing is always be buying. It is less risk, but you have to have the discipline to keep buying when the world feels like it is ending. Understand that markets will go down at some point. Nobody knows when. But when they do, you must treat it as a shopping spree. Even with your active investments, when the market drops, you should be looking to buy more of the good companies then, too. You have to understand the psychology of what creates these bubbles. It is speculation, debt, and hype. It is people getting greedy and buying things they don't understand just because they hope the line keeps going up. That behavior creates the bubble, and eventually every bubble pops. We don't know when. We do know the Federal Reserve is cutting rates, which usually inflates bubbles, not pops them. We know they have ended quantitative tightening, which also inflates bubbles. They are working hard to keep the market inflated. Does that guarantee stocks go up in 2026? No. But we know the government is trying to push them up. So don't just sit on the sidelines. Understand the game. Be ready for the market to go down because anything can trigger it. A bad earnings report, a bad jobs report, or something breaking in the money system. When that trigger happens, be ready to purchase. That is when the real wealth is made, when you come in and buy what everyone else is panic selling. If you can buy a fantastic investment when it is on sale for 30% off, that is how you grow wealth fast. Again, if you want help with this, check out the resources and the free masterclass in the description. And if you found this breakdown helpful, the best way you can thank me is by referring this to someone else. Share this with a friend, a family member, or a colleague. That helps us spread this financial education to more people. Thank you for reading. Just remember, the Fed just announced they are ending quantitative tightening as of December 1st. In plain English, they are firing up the money printers to boost the markets as we head into 2026 to stimulate the economy. This shift is going to affect everyone and every dollar in the stock market. Stay alert.